Welcome back to the Broker Life Podcast. My name is Mark, and today's guest is Janel Melo from Scotiabank. She's a broker relationship manager. Welcome, Janel.
Hi, thanks for having me.
No problem. So first, let's just start off with telling me a little bit about yourself and how you ended up with Scotiabank.
Sure. So I have been with Scotia as a BRM coming up on 2 years next month, actually. I've been on the credit side of the mortgage world about 10 years now. I worked at a few different monolines prior to getting the BRM role. So good experience with working at monolines because you work with different investors there. And then the beautiful thing about working here is you just deal with the one investor. So bit of a difference. But in the previous roles, I actually worked in similar positions with Merrick's as well as Street. That was a pilot position at the time. So yeah, good experience, and then landed at Scotiabank.
And you were also a mortgage specialist at one time, right?
No, I've never been on the broker side. I actually started in the mortgage world on the collection side. So that's kind of how I got my foot in the door in mortgages, as I worked in collections for a company called Resmore for just over 2 years. They were bought out and changed ownership and whatnot. And then long story, but eventually I landed on the credit side of mortgages.
So what is it about underwriting that you like? Why underwriting? Why not sales?
Oh, I love the underwriting. Underwriting is probably my strong point in this role versus sales, which is also part of my role. I like being able to make a deal work and figuring out how to help people buy a home, because it's always, for me, it's looking for a way to get a deal done, not just say, oh, I don't want to do this deal. It's saying, okay, well, this makes sense because of this, and I can mitigate it this way. So I like that side quite a bit of trying to figure out how to help someone or people to get a home.
So people, you'll hear the term underwriter a lot. You'll hear it in lending, you'll hear it in insurance. What is underwriting? In layman's terms, common person.
Yeah, so it's someone who is adjudicating the deal, who is looking at all your documentation, your credit bureaus, to see if you meet the threshold that we have for the rules for how you can apply for a mortgage. So it'd be similar, like you said, to insurance or in car sales, to see if you meet the requirements to qualify for those things. So it's the same. The government has certain, I don't want to say policies, but guidelines, sorry, I guess is the word I'm looking for. And our job is to make sure that the applications we get are within those guidelines, that we're able to approve it to proceed, or if we have to decline it, to say no, like you don't meet the qualifications.
So when a broker like myself sends you a deal, you're the person that essentially gives it the stamp of approval or decline based on all the guidelines.
Exactly, yes, yeah. We're the yes or no person on if you're going to proceed.
So it's important to keep people like you happy.
Yes, it is.
Good. Now, Scotiabank. So many of our listeners may know that I used to be at CIBC for 10 years. You're at Scotiabank, both big six banks, very reputable companies, big brands. What makes Scotiabank, in your opinion, different from other banks? And then I want to kind of get into what makes it different from non-banks. There's a slew of monolines in the broker space. You worked for a couple of them. So let's start with maybe Scotia from the big banks. And this doesn't have to be like, down to the intricacies of policy and stuff, but just from your sort of vantage point, working from a couple different lenders, how does Scotia separate themselves from those two sort of areas?
For me, so this is actually my second time working for Scotia in the last 10 years. I actually worked at the underwriting center a lifetime ago when they had one opened in Calgary. So it's similar roles, similar job title, but also different, I guess, because at the center I was just underwriting, and a BRM is kind of 3 roles in one. But I would say something that I've noticed consistently from back in 2014 when I first started to now is the customer experience is their big focus. And even with the internal emails that go out, because obviously every department is included, it's always such a big focus on how can we do better for our customers, for our clients. Obviously, no bank is perfect. There's always going to be situations where maybe a client didn't like how something was handled, but it's always how can we do better? How can we get better? And the biggest thing, like in the last year, that's been a huge focus and a success, I think, because I personally am biased, but I really like it, is the scene points. So what can we do to for there to be additional things that the client is a benefit to the client? And when it launched, it got huge. So I don't, it's just, it seems like such a huge customer focus all the time. And what can we continue to do to get better? And then the other big thing that they do is they're very inclusive with everything. Like we're always learning about different ways to make sure, and whether it's a client at the branch, how can everyone feel inclusive there, how to handle situations. Like they're always having us learn more, do online courses, and try to figure out how to make everything better from end to end experience. So, and we don't deal in our role, we don't deal with actual clients directly, but obviously we can have a huge impact on clients because we are sending them into branches as well. So just making the whole process more seamless. Like even with us who aren't customer facing, they still want us to learn and make sure we're doing all we can to make the process easiest for the client too.
So when you're comparing your experience to say Merrick's or Street Capital, which is now RFA, do you notice as an employee a difference working for a big brand like Scotia and some of these sort of smaller monolines, or
Oh yeah, absolutely.
what are some of the big differences you notice from, your standpoint?
The biggest like difference I noticed would be training, to be honest, when it comes to just overall, like a big corporation is going to have a lot more tools, I guess is how I would say, to make sure you're prepared for the role. So even when I was hired, at the time I was hired with a group, there was a group of us, they had our training all planned out. We want you to get to this level, we want you to learn this. They had us meet with all different areas of the branch, whether it's, with rates, or you get to know the CSAs, who are the branch people, the sales people that a client would meet with, or whether it's the insurance side. They want to make sure you're comfortable in different levels, not just the specific role you do, but to be able to hopefully answer questions in different areas. Whereas, and a lot of time in different worlds, and that's just honestly that world. So it's not knocking it, it's more sink or swim. So you don't necessarily have the support that you may have here, like the online courses we have here, the training tools we have here, the annual conference we have in these roles. They want us to have all the information readily available. And it's a lot more sink or swim, I guess, when it's a bit smaller, because they're just also not set up for that, right? Like the bank has training for every role you can imagine. So they're always going to be prepared in that sense.
So is it suffice to say that given that banks are so much bigger than some of these other companies, they did just have way more bankroll and they put way more resources into their people? They can train you 6 different ways on Sunday because they just have the bankroll, the experience, the tenure, the access, all the resources and tools, right?
I would honestly, to me, that very much nails it, because it's totally different once you come to this side, and things are constantly changing in the monoline world too, because monolines are heavily investor based, right? So you may not have the same investor next year that you had this year, and that changes everything, and that changes how you're looking at things. And so it's a lot more, I would say, structure on the bank side.
Totally. And I remember my time, 10 years at CIBC. I was in branch for 2 years, and then I was a mortgage specialist for 8 years. We were basically on your own, right? As like we are with brokers. And my experience is dramatically different being a broker for now 5 years and a mortgage advisor for 8 years. And the power of the brand is really something special. And don't get me wrong, I love being a broker. I love being able to provide a variety of options, including the monolines and the banks and everything. That's why we're brokers, right? We want to give choice. But there's no question that the power of the brand is so impactful. I remember, walking into any networking event or any branch meeting or anything, and people just understand who you are. You don't even have to say anything. Oh, you're from CIBC. I know exactly what CIBC is. But if you're coming from even Mortgage Connection, which is getting to be a bigger brand, but small compared to Scotiabank, or even if you talk about some of the lenders like Merrick's or RFA or whomever, people are really gonna have to investigate what exactly is that. And there's like a trust and comfort level that I've sort of discovered. So I think, I'm interviewing everybody. We had MCAP on, we had Strive on here, and now we have Scotiabank. And I love talking about the nuances and differences. Because there's just benefits in all of them. All of them are so valuable, and I don't want people to get the impression that one is better than the other.
No, and branding, right? But like you said, some clients aren't comfortable going with a monoline because maybe they don't know the name, but the rate's way better. So that's where brokers come in, and it's really about educating your client too, and explaining to them, like, listen, this is in your best interest because of this reason. And like you said, it's not that one is better than the other. It's just what's the best fit for your client.
Exactly.
And that's why I think brokers are such a huge value, because it's not just this is the one product, this is the one thing you can get. It's these are all your options. We're going to find the best fit for you. Maybe you don't care about rate, and maybe you care more about having a bank be the name your mortgage comes out of or shows on your title or whatever it may be. Because there are some people that just want, you know, to go with one of the top 6 banks or whatever it may be, because that's just their comfort level. That's what they know.
Yeah, fit is exactly it. And we're going to talk about your Scotia's rental worksheet in a bit here. And that's one of the reasons why I go to Scotia all the time. But so Scotiabank, big brand, anybody can go to Scotiabank and get a mortgage. You know, I think sometimes people didn't know that mortgage brokers can sell or offer bank products or Scotia mortgages or other big bank mortgages as well. So do you know, what's in your opinion, why would a customer rather work with a broker versus a branch when considering a Scotia mortgage? Let's say they're a longtime Scotia client. They've had bank accounts and everything at Scotiabank. What would be the difference from going to the branch and getting a mortgage and going to a broker when it's the exact same company? Any thoughts there?
Yeah, a lot of them. Like I always, even with my friends and family, I'm always like, you go with a broker, and that deal might land at what company I'm at, or it might not. But at the end of the day, the broker, like I just said, you're looking for their best interest. So it may not be the big bank, and you guys do more than just mortgages. A lot of times, like client situations, no one is ever the same. And that's one of the reasons I still like I really enjoy what I do, because no one's situation is the same. You can get 5 applications in a day, and every single one's going to be different for one reason or another. And a lot of times brokers end up being kind of life coaches in some stuff as well.
Yeah.
Because you do more than just mortgages. You can talk to them about insurance, maybe potential investments, or refer them to someone. Again, you can explain to them why maybe a monoline might work better for them than going to a branch. Whereas with the branch, they're just the advice they give. It's not that it's bad advice or anything, but it's just about that one bank and product. You guys have knowledge, and my goodness, there's so many different options. So sometimes I wonder how you guys keep track of it all with the different lenders or products you're able to work with, right? So you have just the variety you have to offer a client. And maybe it's not on the A side, right? Maybe it's alternative lending, maybe it's private lending, but you're able to find a solution one way or another for a client. Whereas if they go to the branch and they just don't meet, let's say, what the bank requires, a branch can't offer them a B lending product or a private mortgage.
Yeah.
Whereas you guys can say, all right, this may not look pretty for the next year or two. Your rate's going to be very high, but this is how we can get the deal to work. So if you really want this house and it's within your affordability, here's the alternative options. At a branch, once they don't meet the qualifications, it's just a no, and that's kind of where it ends. And with you guys, it doesn't.
What are some of the nuances with sending a deal through the broker channel? Because you only underwrite for mortgage brokers versus a client going to a branch, getting a mortgage from a CSA or somebody in the branch, and it goes to a completely different underwriting center.
Yes.
Is your role and the underwriting role for branches very similar, or are they quite
Yes.
different?
Sorry, yes and no. So we're split now. They've kind of over the years restructured it so there's not different levels, I guess. It all goes to the same not center. They honestly they do the same role as us. They just work with internal sales versus external sales, which would be the brokers. But we're all an end-to-end service. So, which is a bit different than other lenders, because like I said previously, our roles are 3 in 1. So we do the sales side with the brokers, and they would do so with the internal guys. We do the underwriting, and then we do, I guess, what would be called like a credit admin role, where we review the documents as well. Some lenders, it's still split. So someone will underwrite, but your document review goes to someone else. So then there's also, you got to make sure that that communication between those two people works. Whereas with us, you're getting an end-to-end service.
You're doing it
So you
all.
submit the deal and you go straight to funding. We have our own funding. It doesn't have to go through FCT or anything like that. We deal directly with our funders, and they have the same service if you go through the branch. So it's good. It's still a seamless process on that end. And there's a lot of like private banking, or like I said, people that have just gone long term that just like to do it that way. And they find it easy to go through the branch, and that's fine. And they know what they want. Maybe they just want a HELOC or whatever else. So it gets restructured that way.
So you've been in this role for how long now?
So the BRM with Scotia role will be 2 years in June, but the last 2 roles I had previous were similar in the sense where they were the sales, underwriting, and credit admin in one.
Okay. So 2 years at Scotia, what are some of the most common products you're seeing right now in terms of getting submitted? So when you're getting deals in, besides like, fixed or variable, are you seeing any specialty programs or products? I know there's a couple that I think are really unique to Scotiabank, like the projected income for medical doctors program. And then, I do think the rentals are a little bit unique, and on how you calculate rental offsets and things like that. But what are you kind of seeing as the most common type of product or client, or like what are you just seeing most of the time come across your desk?
Right now, our volume is down compared to previous years. We're kind of taking a beat this year, I guess is how I would word it. So we are seeing the majority of deals that come in are definitely conventional, and the majority of them are under a specialty program. So right now, I would say net worth program and our holdcos are probably the more popular that I'm seeing. But we do also have, like you said, the projected income, which is quite a good one, and the BFS Plus, which is also a pretty good program as well. We don't offer stated income, so BFS Plus is kind of like our version of that.
Okay, so let's maybe touch a little bit on that one. So you don't have to go into great detail, but the projected income for medical doctors program, and I think it's also vets.
Dentists and veterinarians also have it. You can't project as high as on the doctor. So with the projection, basically what it is, you have to either be doing your residency or within 1 year of graduating, and that's a very hard rule. So I guess the one thing I'll start by saying with any of these programs is they're all considered on exception. So they have to fit with what we need in the program. If they don't fit, it's not something where there's more wiggle room for exceptions. It either fits or it doesn't, because they're already done on exception. So let's say you're with Alberta Health Services or BC Interior, whatever it is. You just have to be working. So you get your standard letter of employment and pay stub during your residency program. It confirms what you're doing, as long as the residency is on our drop down, which is quite a few. So even if it's, let's say, general practitioner, which would be the most common, then you can project their income up to a certain amount. So if you're within your first 3 years of residency, it's a bit lower than if you're in your 4th year or within 1 year of graduation, because the whole point is that you'll obviously be making quite a bit more once you are a doctor or veterinarian or dentist.
So Scotia is basically taking into account future earnings.
Correct. Yeah.
Yeah. So they're saying you're in school, you're in residency right now, and to be clear, in residency, you're still earning an income, right?
You are. Yeah. Typically, you're going to be earning. I think the ones I've seen are like, let's say, between 60, 70,000. Like you're still earning. You're still working with usually your local health region. So that's why I say AHS, like Alberta Health, because that's obviously the one I see the most. You're usually at University of Calgary, University of Edmonton, wherever it is, so you can easily get a letter and pay stub. The amount you're earning does not matter at all. It just needs to show that you're in your residency in your program what year to meet the qualifications, but we go by the projected income amount automatically. It just is to show that here's my letter and pay, like a standard requirement that we have. And you can do the projection income as high ratio as well, or conventional.
That's where I was going to go with that. So you can have 5% down and still get in, or you can have more than 20% down.
Correct. Yeah.
Okay, good. So I like to highlight that one because I think that one's really unique. Let's talk about rentals. So from the broker standpoint, this is the deal we get quite often. So a client has an existing primary residence and they want to keep that primary residence, rent it, and then they want to buy a new primary residence. This is one of the most common deals. And there's certainly different kinds of rental portfolios and investors who already have like 10 rentals, etc. But for the sake of making this simple, let's just say someone has a property, they're thinking about renting it, and they want to buy a new primary residence. We can use rental income on the existing primary that will turn rental. So what I want to know is, how do you calculate how much income is used, and then what are some of the sources of income that you allow, market rents or leases, etc.
So in that case, because your existing is converting, it would basically be you could only get market rents on that, because you can get a lease, but we require 3 months bank statements. We do not make an exception on that unless, like, for example, the property you're purchasing is a rental, and in your offer to purchase, it says you're assuming the tenants, confirms the monthly amount, that sort of thing, then we can accept it. We have a rental worksheet that brokers seem to love, where it basically inputs the rental amount, your mortgage payment. It takes 50% of your total monthly rental amount, and it either gives you a shortfall, which you just put in liabilities, or a surplus. Now, when you're putting the shortfall in liabilities, you put your mortgage payment at zero, so it cuts back quite a bit on the qualifying, or you get additional income out of it, which I'll be honest isn't as common, just with house values these days. But obviously over time, let's say you had a long-term rental, then you would see it more often, but not usually when you're flipping right away. But yeah, so you can just input it, like I said, as a liability. You take out the payment, and it definitely gives you a little bit of room there on the ratios.
And some people might think, well, that's kind of crazy. You can only use 50% of the income to go towards qualifying. But that's actually the standard for most lenders. And what's, I think, a little bit unique with Scotiabank is that you're not including the taxes or heating or condo fees in that calculation, and most lenders do. So not only is it more beneficial because you can take the difference, but you don't have to include those other costs. So really, I don't know what the numbers look like, but whenever I do the math, it seems like you can qualify for, I don't know, I'll say 20 or 30% more, because you're skipping out on hundreds of dollars of other costs per month. So yeah, I love it. And then, 5 years in, I'm still always going to Scotia first to say, let's see if it works on the rental worksheet. And when I'm giving solutions to clients and comparing that just to the standard 50%, it's a no-brainer. It almost always makes sense.
Well, and on the subject, it helps a lot too, because even when you're submitting it and you put in like rental income from subject, it automatically is going to take out your heat, your condo fee, your taxes, and use that calculation. And the system's smart enough to know if you don't include condo fee, or not condo fee, sorry, rental income, then it will calculate that into your ratios. Because let's say you don't need it, your ratios are well in line, so you don't need to verify. So yeah, even on the subject, I find it works quite well, because condo fees could be quite high. I think in BC even higher sometimes than what it is in Alberta. So even just taking that little bit out can help you quite a bit. And then, like you said, even if, like, let's say the rate is higher, which it is right now, and like you're looking at the worksheet, it just might give the client more room to buy by using the worksheet. So sorry, you have to take a higher rate for the next few years, but you're able to buy at a little bit higher price point for the rental that you want, or whatever the case may be.
Yeah, and on the rate conversation, I mean, there's lots of strategies around that. People don't have to sign up for a 5-year fixed. You can do a 1-year fixed. And so there's certainly ways around that. And we're always trying to encourage people, obviously, to not focus as much on rate. It's important, but it's definitely not the all and be all.
I think it depends on the client too. Like a first-time home buyer is going to be a lot more rate sensitive than someone who's maybe building a rental portfolio, and they know it's more about the end game versus right now the short term in the next few years. It's because they're not planning on dumping these rentals, right? They're building it up. So I think rate just also depends on the client you have. Because I know for me as a first-time buyer, when I bought my house, I was like, no, rate. I just want the lowest rate.
So we talked about projected income, talked about the rentals. Any other policy or program that you think is unique for Scotia that you want to highlight? Anything worth mentioning?
Yeah, I would say definitely our net worth program. I don't think there's too many out there. I know some banks do have them, but they won't maybe do them through the broker channel. So with our net worth program, it starts at a minimum requirement of $250,000 in liquid assets. And then it goes up from there, just depending on what your TDS is. And that being said, the TDS doesn't really have a limit. So as long as you have the assets and the net worth to provide, you can really, your minimum requirement is $12,000 in income. And that, unfortunately, there's no way around that minimum income. But even, let's say, CPP or OAS or something like that may add up to the total you need. And yeah, it allows you to buy quite a bit if you have the net worth for it. You can basically just go up from there. So if your TDS is over 60%, we cut back the loan to value to 65%. And then there is no restriction. So let's say you have $2 million in assets and you want to buy a very big house and have a large mortgage. If you have the assets to back it up, you have the $12,000 in income and you can put 35% down, we'll allow you to do that purchase because we're verifying it, which is just needed upfront, like the 90 days. We do need 3 months history upfront to show it. But I think there's a lot of value in that program. And you know what, at 65%, a lot of times people just want like a home equity line of credit instead of maybe locking into a mortgage or whatever it may be, so that they're able to pay it off as they want. And then the other one I'd say that is unique is our holdcos.
Before you get to the holdcos, what's the LTV on that standard product? 80%?
80%. You can't go high ratio on net worth, but if your TDS is under 60, you can go 80%.
So
It's just when
20%
it
down.
goes over 60 that it cuts all the way back to 65. There is no in between, I guess.
So 20% down gets you 20% down plus 12,000 in annual income and a minimum of 250,000 in liquid assets in addition to your down payment.
Yes. Sorry, in
Allows
addition to
you-
the down payment is important. Yes.
It allows you to basically get a mortgage for X amount. Hard to calculate because your debt ratio goes up to 60%. And if it's over 60%, then it's more down payment. Otherwise, it's the same deal. Okay.
Yeah. And then good to know with the 60% too. Everyone I've seen, it just keeps your assets required at 250. It's when you're going over that 60% TDS that number starts to increase.
Okay. Holdcos.
So Holdcos is something we launched just over a year ago now on the broker side. They were doing them at the branch before. And yeah, it just allows you to purchase or refinance if you're in a holdco. The biggest thing that we will ask to verify is that in no way is it an operating company, and the holdco is just for real estate, I guess. You can actually do your principal residence in a holdco as well with us. I would say I don't actually think I've seen a principal residence deal. It's typically rentals that people are purchasing. It could be a brand new holdco or an established holdco. And if it's an established holdco, we just ask you to verify, again, that it's not an operating company in any way. But yeah, there is a rate premium for the holdcos, of course, because there's a benefit to doing them that way. But otherwise, yeah, I would say it's something unique that's not that common. I think there's maybe one or two lenders out there that do it, but it's becoming more, I don't want to say popular, but more common, and I would think for rental investors to start putting their units under a holdco.
Do you know, this might be more down the tax alley, but what is the benefit of a holdco?
I think honestly, I don't know the answer to that. I think it is more down the tax. I know there's tax breaks or whatever else. I don't believe you have to claim them on your T1 generals because it's not your personal income anymore. So I would guess it has to do with that, but I don't know for sure. So I don't want to say what the benefits.
I think you're right. I think it's kind of like BFS, right? So if you're business for sale, if you're incorporated, the liability and everything's on the corporation. But we'll leave that for the tax experts.
Exactly. I was like, I don't know for sure, so I don't want to confirm.
Challenges. What are the biggest challenges right now in the mortgage industry from your vantage point?
Probably the qualifying rates, I would say, because the rates in the last 12 months have increased so much, it just makes it harder for people to qualify for the amount. I will say I'm located in Alberta, and the majority of deals I do are, prairie related. So Alberta, Saskatchewan, Manitoba. So our price point is definitely a benefit out here versus a BC or Ontario, because qualifying out there is really hard considering it's like $1 million for, I don't want to say a shack, but basically a shack in those two provinces, or a house that you're going to have to put in another couple $100,000 is. We're out here, you can get a beautiful home for $500,000, and yet still sometimes it's hard to qualify because of rates. So with the rules being you have to qualify at 2% higher than what your actual rate is, that really changed the game when that happened a couple of years ago. And then when we're in a rising rate environment, obviously it limited people more. I will say though, the benefit to that, which we couldn't have foreseen when all the changes happened back in, 2017, is that the situation we're in now, where it was like it helped people qualify for the shelter shock of the payment. I'm like, okay, now I see why the benefit to it, hindsight. Whereas at the time we were all like, this is ridiculous. Yeah. That's never going to happen. Where it's over the benchmark of 5.25, right? And now here we are. So I'm like, I will say now we understand the benefit of what they were trying to do back then, but that is the biggest challenge I think for brokers too, is trying to see, all right, how do I get this person to qualify, especially for high ratio. We do allow for extended ratios when you're conventional, which is also something a little different from other lenders that we do. So we will allow clients to go over 44% TDS up to a certain amount, which is very much dependent on what your credit looks like. Yeah. So a big thing for clients that they may not always understand until it's time to apply for a mortgage and a broker pulls their credit bureau is that your credit can make or break you in this process. So the stronger that your credit is, the longer you've had it established, the more you show it being paid down. Don't keep it at limit or over limit, all these little things. That'll impact if we'll allow you to go over a certain threshold for your ratios. So that's something also a little different we do. It's not really a program, but it is something we do allow. If your credit is really strong, then we will consider that.
Well, exceptions are a big thing, and people are always asking for exceptions, and brokers are always trying to get exceptions. And
Oh,
your
yes,
your point is well made. If you have good credit, it's a strong file. It's easier to get these exceptions. But if you're a first-time home
absolutely.
buyer, if you got poor credit, good luck. Yeah.
And the
Uh,
history of it, right? Because if you have a thick credit profile showing, 10 plus years of consistent repayment, your utilization isn't 100%, because that's a big one. Even if it's 50 or 60, your credit score is going to reflect that. And we can see the consistency. All right, this guy, maybe he has one or two, clearly an oversight because he only has $100 on that card. That's not going to impact it, right? Like, that's something we can easily mitigate. It tells a story, I guess is what I'm trying to say your credit profile does. So if we can easily tell the story and something's isolated or whatever, that's easy enough to mitigate. It's when there's a lot of missed payments and it's like, oh, well, the client didn't realize the payment was coming out or something like that. It's like, well, multiple times that happening is harder to mitigate than one time of that happening.
Good segue. So, what is one tip you would give potential home buyers looking to get a Scotia mortgage this year?
Do not buy a car right before you're going to buy a house.
Yeah. Don't buy a big truck. Yeah.
Yeah, do not go out and get a car loan or any type of loan. To be fair, I'm not being biased against new vehicles, because every single thing is taken into account on your credit. So we have an advantage where we tend to get both credit reports. Brokers supply us with Equifax and we internally pull TransUnion. So we get a full picture because there's sometimes things that don't report on one and do report on the other. And going out and trying to get credit can hurt you. And a lot of time that's advice that, for example, people that are new to Canada who would be first-time home buyers are told, go out and establish credit. And they take that as, I'm going to open 5 trades in a year. Well, then on your report, it shows that you have a huge amount of credit all of a sudden, but it doesn't yet show the history of you paying it. So there's nothing wrong with going out and getting multiple trades, but don't assume you can go get a mortgage right away because you have to have a history of it showing paid. So the magic number for me is always 24 months of consistency. And that's a big one, I'd say. If you're starting to get ready to buy a house, don't think that you can go out tomorrow. Like, take a look, have a look and see what your report looks like over the last 24 months. You could do 12 months, but even 24 months for me, 2 years gives you a good picture of how someone handles their credit, I guess is how I would say it. But do not go out and get a brand new car loan.
I couldn't agree more. I always tell clients the 2 by 2 rule: 2 trade lines, 2 years, at least $2,000 limit each. And
Yes, that's actually that's a great rule to give clients because that's something that we look at. And no matter what lender I've looked at, that's kind of a mindset I've had.
yeah, I make sure to share that because people get excited, right? It's like they just moved to Canada and they want the dream, the Canadian dream, especially if you're in the prairies where it is more affordable and they
Yeah.
want to get in that house right away. But you really do got to prepare, and lenders know this, and lenders are taking a risk. Someone brand new to the country, not working that long, not a lot of credit. So yeah, take your time, I guess. Take your time and don't buy a car right away.
And there are great new to Canada programs. Unfortunately, with some rule changes this year, the work visa part is not as easy as it used to be for new to Canada. But even then, honestly, I think almost every lender offers the new to Canada programs because a lot of them are with mortgage insurers. So they're insured. And yeah, there are great options for people, I guess is what I'm trying to say. Even if you are new to Canada, it's just with the recent rule changes, that made it a little bit harder, but
Yeah.
there's still some options.
Okay, let's go projections. Your favorite part here. So I'm gonna spit some stats out at you, and then I
Okay.
just want you to give me your opinion on where you think things might end up here. No pressure at all. Nobody has a
Okay.
crystal ball. Okay, so inflation's down to 4.3% from the 8% highs. We're basically halfway there. The Bank of Canada wants us to be in that 1 to 3% range. It sounds like by all estimates, we're going to be at 3% by the end of this year and hopefully 2% by the end of next year. Who knows? Bond yields are down 0.5% from the February highs, but we're still up about 1.5% from pre-COVID rates. And the bond yields, if people don't know already, is essentially the indicator on where 5-year fixed rates are. So if the bond yields go up, the 5-year fixed rate goes up, and vice versa. So they're down slightly from February, so we're trending downward. Inflation's trending downward. And lastly, the Bank of Canada paused the last 2 rate announcements. So they haven't increased rates last 2 after 8 consecutive hikes last year. So all good news, right? Inflation's down, bonds are down, and there's a pause in the Bank of Canada. So Janelle, where do you see interest rates by year end? Let's start with that one.
I think in general, outside of our situation, they will be lower. This is a very personal opinion as someone who's not as financially versed, I would say, as yourself with all those numbers you just hit me with. But I think what we had as rates in 2020 up until 2022 were unrealistic. I don't think we're going to see them that low. I mean, I never thought I'd see them that low in my lifetime for what my current mortgage rate is that I have another few years on, to be honest with you. I think we're going to end up hovering between, once everything is balanced out, between 3.5 and a 4.5, I think is the norm. When you look at other countries, our rates were always so ridiculously lower than when you could get in the States, over in European countries. So I don't think we're going to see those rates again. I think us as a bank, we're going to stay kind of where we've been for a little while. We had record-breaking years for what we funded, and now it's just about finding that balance, right? So I think we're going to take 2023 to kind of make sure we're balanced and that we're not in a position where we're, funding way more than we should be based on what our deposits are, and just so that we're more in line, I guess, for long-term wise. I think this year is going to be a short-term pain for long-term gain, I guess is how I would word it.
That's a good point. That's a really good point, because I always forget, big banks are balance sheet lenders, and there's a bigger story than just like the monolines, where the investors are really the main source of investment. So that's good. So you kind of think 3.5 by 4%, 3.5, 4%. You willing to put
long term though, not right now.
You think in 2 years, 5 years? Where do you think we end up there?
I think by end of next year.
So another year and a half.
I think 2024 is going to be a very different picture than 2023 was for most lenders. And I think the balance is going to be found next year.
Yeah.
I think this year is very much, it's all over the place. And like you said, the big difference between us big banks versus the monolines is that it is all about balance sheet lending. And a lot of the big banks lend to these monolines, right? Like that's some of the back end investors, right? Like Scotia, TD, BMO, RBC, they're all back end funding these monoline mortgages. And that's one thing clients don't understand, but that's why there's promo rates and whatnot. You have to fit in within that lender's guidelines with these monolines. And that's one of the best things about working at a bank, by the way, is one policy guide is a very big win, let me tell you. But yeah, I think there's some big banks out there right now that I know, I'm not going to name names, but their balance is too reserved. So they're trying to fund as much as possible. They need to fund more mortgages, or maybe another book is too risky. And I think like we've just found this balance, and we're just trying to figure out how we don't go through, because like I said, it was record-breaking years for 2020 and 2021. And even last year in 2022, our rates were moving up, and we were historically higher than other lenders, not by as much as we are now, but we still had a crazy funding year, and we still exceeded our expectations for funding in 2022. So that's why in 2023, we're kind of coasting, I guess is how I would say, until we make that comeback in 2024. But it is, balance sheet lending is finding the balance, right? And making sure there's not a situation again where, like, some banks, like I said, they're too not reserved. What's the word? Cautious lending. What do you talk? I can't think of the word.
Risk adverse.
That I was told.
Yeah.
They're too what is that word? Like they need more risk. There's not enough risk in their book is what I'm trying to find the word for. So that's why you see such a discrepancy right now in some rates with big banks versus other big banks, I guess. So, and even, I hear stories of clients going to another big bank, not even that's in the broker channel, and they're not giving their clients the rates they were giving a few months ago because they're in the same boat. The difference is they're not in the broker world, like they don't have the broker channel. So it's maybe not as out there in social media as banks that are in the broker channel, because you have brokers vouching for all these lenders or speaking out against some lenders, right? Mm-hmm. You just may not hear about it as much because, brokers don't have access to them, so they wouldn't know.
Totally. Is it as easy to think that, and these are probably questions that are over both our heads, but is it easy enough to assume that deposits in equals, more of an appetite for lending, and less deposits in means like we need to peel back a little bit? Is it more complicated than that, or I think
that'd be like a really simplistic way to explain it. There's always going to be, like, I guess the way to look at it with these big banks, we're fortunate with the rules that the government has in place for banks and the requirements they have, because it put us in a position where we're not like the States where you see that these banks are going under, or people are pulling out their money and stuff like that. Like, that doesn't impact us because of how strict the federal guidelines are for banks. So there's always going to be, like, even when I say we funded a lot, like, it was never a risk where it's like, oh my God, we don't have money. No, it was just like, all right, guys, we just need to take a step back to start rebuilding now because we funded so much. Because there's all these things in place to make sure that that doesn't happen. So I will say how strict it is with our federal government on the requirements for each bank definitely helps make sure that we're not in a position like, what are we at? Like 3 major banks now in the US, I think, have gone under or whatever. Like, that thankfully doesn't happen in Canada because of this situation. So, but I think, I would think the way I always kind of look at it is you need double the deposits for your funding. Is kind of the simplistic way of looking at it. So,
that's a good way to think about it. And that, the whole U.S. banking collapse system is interesting too, because there's a totally different systems. And a lot of these banks, from what I understand, are state banks. They're not federal banks like Scotia's across Canada, right? They're massive.
And something to understand is they have so many banks in their states. Like, it's crazy. It's not just, Bank of America. They have so many little banks you've never even heard of. So we may have credit unions and stuff here, but it's nowhere near the risk, I guess, that they're willing to take. I feel like anyone can call themselves a bank in the States and be like, all right, we're a lender now.
Yeah, totally. Now, that's interesting because Silicon Valley, right? That's a good example. I wonder how big of a story this really is if there's so many lenders in the US and 3 or 4 have gone down already. And it's obviously all over the news and everyone's panicking. Here comes Bitcoin charging in, right? I wonder if it is that big of a deal because the big banks, the Chases and Bank of America and those bigger ones, so far are holding up. And so I wonder if this is just like a drop in the bucket, really. And, the government isn't that concerned. Interesting to see what happens.
Silicon Valley was interesting to me because of the location, because that area is known for the millionaires and the tax and all of that. So I feel like that one is a bigger deal even maybe than they let on, just because of the clientele they would have had in that area.
That's fair.
But that's a personal opinion. I don't know anything about it.
Well, let me throw another wrench in the old dryer here. So TD Bank's been getting some heat because TD Bank was invested in some US banks that were going under. I can't remember which ones. They had some investments and their stock has plummeted the last, I don't know, a couple of weeks. I think it's kind of,
really?
Yeah. But they were in the news for a minute and they were getting a lot of heat about that. And so as an investor, TD's very much invested in the US. I don't know about Scotia. Is Scotia invested in the US? They have some Caribbean banks, I think.
We do have some investments in the States, and we actually did get it confirmed that we didn't have any affiliates with any of the issues that have gone on. So Scotia's really big in South America and the Caribbean as well. I would say they're not as big in the States as like a TD Waterhouse, because they're big for investments in the States. But we're all over like South America and the Caribbean.
So maybe some risk there, a little bit of risk there, but as a whole, much safer,
Yeah, it's just I learned a lot, I guess, in the last 6 months because of the balance in our rate situation about, I guess, what the government requires of banks in Canada. And I'm like, you know what, it may seem at times annoying with all the rules, but I'm like, it really does protect us against situations that are happening, below the border, because as you know, we're tied to everything that happens in the States, right? So there's certain things, at least, I don't think TD has too much to worry about. I think a lot of it has to do with how the media spins things,
noise,
to be honest, with the noise, because they would, in Canada, for sure, they have the same rules that I just explained, like how it's so strict. And I don't see as someone who's worked with them at different monolines as a back-end investor, they are very reserved with their guidelines and their lending. And I don't think that they would go that wild in the States just based on having underwritten by their guidelines at past lenders. So I think a lot of that, the stock plummeting, is people having a quick reaction to something said in the news or the media and stuff like that. I don't see them having put all their eggs in one basket in the States to have them, go under or anything like that. Like, it doesn't seem like their style, I guess is how I would word it.
Here, go Canada.
Yeah.
Okay, well, I want to wrap up this call with a little fun thing that I like to do at the end of each call. It's just a speed round of questions, or call it this or that. Some of them, most of them are non-mortgage related, so we can take a deep breath here and just kind of
Okay, all right, no setups.
No setups, and people will get to know you maybe a little bit of a deeper level. This is kind of just a fun way like to end it. So let's pound through these 10 questions in no particular order. House or condo?
House.
Fixed or variable?
Ooh. So, that's a tough one because right now fixed, but I always used to say variable, but
That's fair.
that's a tough one. You know what? Variable. Sorry, variable. Go back to variable.
Sticking with it. Yeah, there you go. Okay. Coffee or tea?
Coffee.
Run or lift weights?
Ugh, neither. But lift weights, I guess. I don't run. I always joke if you see me running, you should start too, because I don't run.
That's what Kevin at KDK Financial said last week. He's like, neither. Sugar or salt?
Sugar.
Beer or wine?
Oh, beer. That's a tough one though.
That is tough. Morning or evening?
Evening.
BMW or Mercedes?
Mercedes.
What music do you listen to these days?
I listen to a lot of Spanish music, to be honest. A lot of I'm Dominican. Yeah, I was like, I'm Latin, so I listen to a lot of Latin music.
Really?
Yeah.
Do you have kids?
No.
So I got two young ones, and we're watching kids shows all the time, right? And there's a show called Encanto on Disney Plus.
Oh, I know about Encanto.
Do you? Yeah. It's a great soundtrack.
It is, and you know what? It was such a beautiful representation of Latin culture. It was, it's a beautiful movie. You don't have to be a kid to enjoy these Disney movies, let me tell you. I love them. And I do have a niece. I have a 6-year-old niece, and she can almost word for word sing all those songs and belt them around the house. But yeah, great soundtrack to right.
Yeah, I was singing to myself, we don't talk about Bruno for days.
Oh, I know. And you can't say that name still. She
Yeah.
looks at me. She'll look at you and correct you we don't talk about that, Thea. Okay.
Yeah. That's good. That's interesting. Lastly, what is the last book you read?
The last book I read, I'm a big on rereading books that I like, so I'm trying to think of the last original book I read.
Or you can just say book recommendation. One of your faves.
Ooh, that's hard. I actually quite like reading, so I'm like, now I gotta figure out which one I'm gonna recommend.
Off the top of your head.
Discovery of Witches actually was one of the last ones that I reread. I had read the trilogy already before, and quite a good series. So
Discovery of Witches.
Yeah, and it's actually on Prime. It's a TV show. As it got made into a TV show after. The books are way better, full disclosure, as they always are. But yeah, I like reading. I was like, I don't know, I'm all over the place. And then I reread Da Vinci Code recently. I like Dan Brown a lot. Like his books are good.
So fiction?
Yeah, I'm big on fiction. I'm not big on maybe I should read more self-help books. I don't know, but I'm big on fiction. I figure the world is scary enough. I like to escape into these fantasy worlds that are not realistic.
I like that. That reminds me of my sister. She's big into it as well. Last question. People know where they can find Scotiabank. People aren't going to necessarily follow you or contact you because you're an underwriter, but just for the masses, where can they find Scotiabank?
Scotiabank.com.
Okay. Easy enough.
You can find them online, but yeah, you can go in a branch, and like I said, I always recommend dealing with a broker. So
perfect. Well, thank you so much for doing this today.
Thank you for having me.